paying off a mortgage early. How does it work? What does it look like? Well, let's take a look. So let me move this over here so we can take a peek. Okay, let's say we have a $280,000 mortgage. It's at 6.27% for 30 years, and your start date is December. Now, what would happen if you paid an extra $500 a month? That's what we're looking at. You don't need to pay that much more per month, just if you pay a little bit extra. But let's see what happens with this, paying an extra $500 a month. This, by the way, was still a lower payment than a 15-year mortgage. The other thing to take a look at, too, between a 30 and a 15, is that if something bad happened, like the illness of one of the borrowers, the death of one of the borrowers, the economy going down, you are not tied to that higher payment. We saw back in 2007 and 8, we saw people lose their homes because they couldn't afford that 15-year payment. They could afford a 30-year, but they couldn't afford the 15. The bank would not redo it because they didn't have a job, so they couldn't qualify for it. So having a 30 and paying extra for some people in some professions is a little bit of security. So we have a monthly principal and interest payment of $1,728, and then they're going to pay an extra $500 a month. So what happens? Well, the original payoff date was December 2052, and it will now be February 2040. So you'll save just about 13 years in payments. What it saves in interest is tremendous. $164,881 in interest that you'll save if you can do that all the way through. Then take a look at the graph. That's where you can really see what happens. So it is absolutely worth paying extra if you can do so. And it doesn't matter how much extra, just a little here, a little there. Some people will contribute all of their tax return, and that is how most people get their mortgages paid off early. Thanks so much. And Patty Laforte at Mortgage Lending LLC, NMLS 1977614, Mortgage Lending LLC, NMLS 2293630.